this video we are going to look at externality. So externality is a cost or benefit that result from an activity accrue to people who are not directly involved in the activity. Directly involved in the activity. Let me give you an example. Suppose Ray is a classical violinist and Sarah, who is a neighbor of Ray, she's a fan of classical music. So whenever Ray practices the violin, Sarah gets benefits from it. Okay. So Ray's practice generates a positive externality for Sarah. So this is an example of positive externality. Now let me draw a graph. So this is marginal benefit to Ray, and this is marginal cost to Ray. So Ray will practice until the marginal cost is equals to the marginal benefit, right? Now since Ray's practice generates a positive externality for Sarah, so there is some marginal benefit to Sarah, right? So let's say this is the marginal benefit. Now when we combine the marginal benefit to Sarah and the marginal benefit to Ray, we get marginal social cost. Okay, and this equilibrium point is marginal benefit equals to marginal cost. So this is marginal social cost should be greater than the marginal benefit to Ray, right? Because there is some additional benefit to Sarah, which is positive externality. So since marginal social cost is greater than the marginal benefit, Ray should practice more, right? But if he does not take Sarah's benefit into account, he will practice too little. So whenever there is positive externality, people tend to do too little of the activity. So too little of the activity. Like in this case, if Ray does not take Sarah's benefit into account, he will practice too little. Now let's consider the example for negative externality. Now let's say there is another person, AD, and he is bad at playing a violin. So he creates negative externality to Sarah. So this is negative externality because he is bad at playing violin. Let me draw the graph. So this is marginal benefit to AD, and this is marginal cost to AD, and he will practice until the marginal benefit equals to marginal cost. Now this time AD's practice generates a negative externality to Sarah. So let's say this is the marginal cost to Sarah. So in this case, marginal social cost is greater than marginal benefit, right? Okay, in the previous example, I wrote something wrong. Let me correct it. So this should be marginal social benefit should be greater than the marginal cost to Ray, right? Okay. Now here, marginal social cost is greater than the marginal benefit to AD. Okay. So he should practice too little, right? Because he is creating negative externality to Sarah. But if AD does not take Sarah's cost into account, he will practice too much. So whenever there is negative externality, people tend to do too much of the activity. Too much of the activity. All right. So this is about positive and negative externality. Now let me introduce some terminologies. So the first term is private cost. This is the cost paid by the consumer or producer. So cost paid by the consumer or producer. Second term we have is the external cost. This is the cost paid by other people. Other people. Other people means other than the consumer or producer. Okay. Now we have social cost. So this is cost to everyone. We can also write this is the sum of private cost plus external cost. Okay, so this is the sum of private cost and the external cost. Now similar to cost, we have private benefit and external benefit and social benefit. So social benefit is the benefit to everyone, or this is private benefit plus external benefit. Okay. Then we have social surplus. So this is social benefit minus social cost. We can also write this consumer surplus plus producer surplus minus everyone else's economic surplus. Sorry, this is plus, okay? Economic surplus. Everyone's else economic surplus means the surplus generated by other market participants, okay? Now let's look at the graph. So this is quantity, this is price or cost. This is demand curve. We also call it marginal private cost. Sorry, private benefit, okay? This is private benefit. And then we have supply curve. We call this marginal private cost. Now suppose there is only marginal external cost and there is not marginal external benefit. So the supply curve will shift upward parallelly by the marginal external cost. So let's shift the supply curve parallelly upward. So this is marginal social cost. And this shift is exactly by marginal external cost. external cost. Okay, now this equilibrium is the market equilibrium quantity QM, and this intersection is socially efficient quantity. So in short, I can write Q efficient. Okay, so you can notice that since market equilibrium quantity is higher than the socially efficient quantity, which means we are overproducing and over consuming the goods, right? Because we should be producing at the socially efficient quantity. Okay, so if we are overproducing and over consuming, then there must be deadweight loss, right? So this triangle is the deadweight loss. Okay, and I'll show you how you can obtain this deadweight loss. So this is deadweight loss. All right, now let's calculate the economic welfare, total economic welfare at the market equilibrium quantity. So economic welfare. So economic welfare is simply total benefit minus total cost. Now let me name the areas. So suppose this is A, B, C, D, E, and this is F. Now what is total benefit? We are calculating the economic welfare at the market equilibrium quantity. All right, and please consider the new supply curve, that is marginal social cost curve. Okay, so the total benefit is the area under the demand curve until the market equilibrium quantity. So this is A plus B plus C plus D plus F, right? What is total cost? So this is area under the marginal social cost until the market equilibrium quantity. So this is B plus D plus E plus C plus F. Now we can cancel B, D, F, okay, and C as well. So we are left with A minus E, and we have seen that E is the deadweight loss, right? So we are basically subtracting deadweight loss from A. Now how can we eliminate this deadweight loss? So we can eliminate this by imposing the tax which is equal to the marginal external cost. Okay, so the amount is equal to the marginal external cost. Now you can see you can calculate the total economic welfare again after tax at the socially efficient quantity. So after tax you are producing at the socially efficient quantity. Let me erase this to make some space. So now consider the total socially efficient quantity after tax. So what is the total benefit? So total benefit is A plus B plus C, right? And what is total cost? So total cost is B plus C. We can cancel B, C. So we are left with A. Okay, so now deadweight loss is eliminated. All right, now let's look at another case when there is marginal external benefit. Let me draw the graph. So this is quantity, This is price or cost. This is demand curve. We call this marginal private benefit. And then we have supply curve. We call this marginal private cost. Now we have only marginal external benefit, so the demand curve will shift upward parallelly, okay, by marginal external benefit. Okay, so let's shift this upward. So this is marginal social benefit, okay, and this shift is exactly by marginal external benefit. Okay, and this quantity is the market equilibrium quantity, and this is socially efficient quantity. Okay, now again let me name the areas. So suppose this is A, B, C, D, E and F, and in this case you can notice that market equilibrium quantity is lower than the socially efficient quantity. So in this case we are under producing and under consuming. So again in this case we'll have some deadweight loss. So this triangle is the deadweight loss, and I'll show you from the calculation of total economic welfare. So let's calculate the total economic welfare. Economic welfare, this is total benefit minus total cost. Now we are calculating the total economic welfare at socially efficient quantity. So what is total benefit? So please consider the new supply demand curve, that is marginal social benefit curve. Okay, so the total benefit is A plus B plus C, D, E and F, right? And what is total cost? So total cost is C plus E plus F, right? And we can cancel C, E and F. So we are left with A plus B plus D. Okay, so this is the reason. Now let's calculate the total economic welfare at the market equilibrium quantity. Let me erase this to make some space. So at market equilibrium quantity, total benefit is A plus B plus C, right? And total cost is simply C. So we can cancel C and we are left with A plus B. So as you can see, since we are underproducing, we are lacking D, right? This reason we do not have when we are calculating the economic welfare at market equilibrium quantity. This means the reason D is the deadweight loss. Okay, and like previously, we can eliminate the deadweight loss by the subsidy. Okay, so we can apply the subsidy here, and this is exactly by the amount marginal external cost, benefit. Okay, marginal external benefit. And you can again calculate the total economic welfare after the subsidy. You will see that the deadweight loss will be eliminated. Okay, so this is all about external cost and external benefit. Now before I end this video, I want to explain one more concept. Suppose you have minimum wage and wage subsidy, and you are asked to choose which one is better. Let me explain it from graph. So this is quantity, this is price, and this is the demand curve, this is supply curve. Okay, and suppose this is the minimum wage. All right, so this is the wage received by the workers. So wage received by workers. Okay, now what is quantity demanded and what is quantity supplied? So since this is demand curve, so this intersection will give you quantity demanded, right? And this is supply curve, so this intersection will give you quantity supplied. So you can see that there is the excess of supply, and suppose this is labor market, then there will be excess of labors in the market, right? Which means there will be unemployment. Okay, now let's consider the wage subsidy. Let's say this is the wage subsidy, and what is the wage received by the workers? So this intersection gives us the wage received by workers, which is same as before when there was minimum wage. So this is wage received by workers, and what is wage paid by firms? So this is wage paid by firms. So since workers are again receiving the same wage as before, and what is quantity demanded and quantity supplied? So this is quantity demanded as well as quantity supplied, right? So in this case there will be increase in employment because this is the market equilibrium quantity, right? And since the quantity demanded and supplied is higher than the market equilibrium quantity, that means there will be increase in employment. All right, so from this graph you can conclude that wage subsidy is better than minimum wage, right? Okay, so that's all I wanted to share. Let's stop this video here. Thank you so much for watching this video.